Hello and welcome back to Intertax Learning. Today we're talking about the requirements of U.S. tax resident individuals. I'm breaking this subject into two videos because there's a lot to cover. Without further ado, let's start. There are three ways to become a U.S. tax resident individual. If you are a U.S. citizen or permanent resident, you are automatically a tax resident. If neither applies to you, then we look at how many days you've been in the U.S. Here's the calculation. Add all the days you were in the US this year, plus 1/3 of the days from last year, plus 1/6 of the days from the year before that. If the total is 183 days or more, you pass the substantial presence test. You will be treated as a US tax resident in the current year. Now, you may not want to be a U.S. tax resident if you're only here temporarily. Even if you pass the substantial presence test, you can still claim not being a U.S. tax resident if you meet all four of the closer connection requirements. First, your current year's stays in the U.S. are less than 183. Second, you have a tax home in a foreign country. This may be your home country. Third, you're not in the process of applying for a green card. Fourth, you can show a closer connection to a foreign country than to the US that may be demonstrated by having many of the connections such as a permanent home, a family, a bank account, a job or business tie, a driver's license, social ties, or your voting rights. Let me show you how this works through an example. Imagine you are a UK citizen. Your tax home, family, and jobs are all in the UK. Your work requires you to travel and work in the US starting from 2024. You stay 60 days in 2024, 120 days in 2025, and 150 days in 2026. If you perform the substantial presence test, you will find out that you passed the test. That means you're both a US tax resident and a UK tax resident starting in 2026. But you probably don't want that. Let's reflect on what you can do. You've only stayed 150 days in 2026, which is less than 183. Your tax home is still in the UK. You're not applying for a green card. Your real life, family, home, community, these are all in the UK. So you can claim the closer connection exception. In that case, the US only tax you on your the US only taxes your US effectively connected income, and the UK taxes your worldwide income. You can claim a foreign tax credit for the US tax paid. Conceptually, you only suffer tax from one country. If you want to learn more about effectively connected income or foreign tax credit, let me know by leaving a comment. They are both really important concepts in international tax. If anyone's seen my post from yesterday, I posted a riddle. Let's solve this riddle together as a review session. Some people cross the border and stay non-resident. Who are these people? Those without a permanent resident status, those who did not pass the substantial presence test, and those who passes the test but meet the closer connection exception. Others never leave home and become US tax resident without realizing it. Who are they? These are people who apply for their green card while being in their home country. All right, that's it. Today, we went through the requirements of a U.S. tax resident individual and the closer connection exception. In the next video, we'll talk about what happens when you stay too long, which brings us to the dual residency issue and the treaty tiebreaker rule. I welcome your thoughts on these subjects. Subscribe if you'd like to learn more. If you want to learn the full structure of U.S. international tax, everything is mapped out in my blueprint notes. It gives you the entire mind map, every subject, how they connect, and the key exceptions. I highly recommend using it as your study system. Thanks for watching. I'll see you in the next one.